Passing the CISI UAE Financial Rules and Regulations exam requires memorizing specific numbers, hard thresholds, and exact percentages. Broad conceptual understanding will leave you exposed. The examiners write questions designed to exploit slight misreadings of the rulebook. Your ability to recall precise figures is your only defense against these deliberate traps. These are the exact AED capital requirements. Category 1 needs 30 million dirhams. Categories 2 and 3 need 50 million. Category 4 requires 5 million. A commodity's central counterparty requires 50 million, but 10 million must be provided by the CCP itself as skin in the game. When classifying natural persons as investors, the terminology changes the math completely. This matrix highlights the numerical threshold differences between investor classes. A professional investor requires 1 million dirhams in liquid assets or 2 million in net assets. A qualified investor requires 4 million in net equity or an annual income of 1 million. Candidates fail these questions by mixing up the liquid asset figures with the net asset figures. You must memorize which metric pairs with which classification. This stepped meter marks the exact triggers for AML compliance. Wire transfers trigger checks at 3,500 dirhams. Standard customer due diligence triggers at 55,000 dirhams. Beneficial ownership identification kicks in at exactly 25% controlling ownership. Money laundering regulations do not offer leniency. An attempt at money laundering carries the exact same penalty as a successful operation. Informing a client about a suspicious transaction report, known as tipping off, is a standalone criminal offense. Corporate governance follows similarly strict mathematical lines. If a related party transaction exceeds 5% of company assets, it requires board approval. If it exceeds 30%, board approval is invalid on its own. It demands General Assembly approval. Compliance in the UAE is not based on subjective risk assessments. It relies entirely on crossing these exact numerical thresholds. REIFs have strict operational rules. They must hold 75% of assets in real estate and generate 90% of revenue from those assets. Annually, the fund must distribute 80% of net profits and cap total borrowing at 50%. Venture capital funds operate under a different constraint. Exactly 70% of their assets must be placed in qualifying investments. Specialized funds are heavily tested on these exact percentage allocations. A single percentage point off means the fund operates outside its legal risk profile. DGCX contract sizes vary wildly. WTI crude is 1,000 barrels. Mini WTI is 100 barrels. Dubai, India is just 3 barrels. This calendar comparison explicitly shows the delivery months for precious metals. Gold contracts offer 6 delivery months. Silver only offers 5. Regulatory reporting structures are a common exam trap. The Securities and Commodities Authority reports directly to the Cabinet of Ministers. The exam will attempt to trick you by offering the central bank as an option. This timeline maps the staggered record-keeping requirements. AML records must be kept for 5 years. Central counterparty records require 10 years. ADX records must be retained for 15 years. Examiners intentionally test these specific irregularities, like silver's missing month, or the 3 distinct record-keeping timelines, to separate prepared candidates from unprepared ones. Passing the UAE FRR requires commanding this data without hesitation. The capital limits, the compliance triggers, and the reporting timelines are absolute. There is no room for approximation. Precision memory is your only defense.